We were looking at the case where we have a central bank plus a banking sector. In that case, we saw that how we can express financial market equilibrium in two equivalent ways. One, where demand for central bank money HT is equal to supply of central bank money HS. The other equivalent way to express financial market equilibrium would be where overall money demand MD is equal to overall money supply MS, which we saw is equal to the money multiplier times supply of central bank money. The equilibrium, and because both of these ways are equivalent, which means that they yield the same answer. So the equilibrium interest rate I star will be the same in both the money market, where MS is equal to MD, as and also in the high powered money market, where HS is equal to HT. So both of these are two equivalent ways to express financial market equilibrium, which means that they yield the same answer. The equilibrium interest rate is the same, whether found through HS is equal to HT or MS is equal to MD. Right, so one can therefore analyze the determination of the interest rate in the case where we have both the central bank and the banking sector with reference to either market. We can either look at the money market and IMS and MD, or the high-powered money market IHS or HT. Right, and we'll reach identical conclusions for the equilibrium value of the interest rate. In either case, we can see whether we find through HS and HT, we get I star. We get the same I star whether we look at MS or MD, because both of them are equivalent ways to express financial market equilibrium. So we can find the equilibrium interest rate by either setting HS as HT or MS as MD. If any parameter exogenous variable changes, that causes the same change in interest rate in both markets. So we have two equivalent ways to express financial market equilibrium in the case where we have a banking sector. One way is that we can do it where HS is equal to HT and or MS is equal to MT. Here we have to be careful that in case 2, we distinguish between HS, supply of central bank money, and MS, overall money supply. Because when we have a banking sector, what the central bank directly controls is the supply of central bank money HS, and the presence of the banking sector results in a multiplication of the central bank money through the money multiplier process, with overall money supply as money multiplier times supply of central bank. Similarly, in case 2, be sure to distinguish between demand for central bank money HT and overall money demand MT.